Hey guys, welcome to another segment brought to you by Freeman CPA and Atlanta Business Accountants. So, great segment. Now we're starting to get into the nitty gritty, and we're going to discuss a few more key terms before we actually see how all of this applies to your specific situation. Now remember folks, taxes are highly complex, so just because we go over something here, there might be some nuances that are not exactly covered. There's many different situations that can apply. Always consult with your tax advisor, making sure that you're crossing all the T's and dotting all the I's, because here we're just going to discuss the basic terminology. We're not going to dive into how it can specifically apply to you, but in an overall sense, it will be very applicable to everyone. So let's talk about passive activities. What are passive activities? So passive activities would be the opposite of an active activity. So an active activity is somewhere where you're working actively, and a very classic example of an active activity would be earning money at an employer, so your basic W-2 situation. All right. But let's look at the basic definition of, what is a passive activity so that we have an idea of what it really means, because it's very vague to just say, hey, I'm not very active in this activity, so I must be passive, right? Let's talk about the specific definition. So the IRS has a definition, and it's basically a passive activity is any trade or business of the taxpayer in which the taxpayer does not materially participate. Now, I don't want you to just worry yourself about what material participation is and what are the tests, but obviously you can Google it. And so let's go on. So number 2, any rental activity of the taxpayer except as provided under Section 469 C7, which obviously now you know what Section 469 of the code is. So basically, if any rental activity of taxpayer except as provided under Section 469. So hence, rental real estate is deemed a passive activity, right? Any rental activity of the taxpayer except as provided under Section 469. So any rental real estate is by default basically put into this category, into passive activity, whether we put that into an LLC or whether we put that into an S Corp or C Corp or a closely held corp. These are all still, you can't take a zebra and change its stripes, or you cannot take a donkey and make it a racehorse. It's still going to be a donkey. It's still not going to be a racehorse, right? We cannot change the stripes. So just by taking rental real estate and thinking that putting it into an LLC or an S Corp or maybe some other type of entity like a trust, that all of a sudden we're changing the basic characteristics of what rental activities are. No, it doesn't matter where we put it. It will still be treated as a passive activity by default. Now, the thing to know is that this particular passive activity does not specifically apply to S corporations and partnerships on their level. But remember that partnerships and S corporations are what we call pass-through entities. They don't actually pay income taxes. And what they do is they pass through the activity over to the shareholders and the partners or members of the partnership. And therefore, all of that plays out on an individual basis, and yes, they will be subject to the passive activity loss rules. So if we put our real estate into an S Corp, or we put our rental real estate into our S Corporation or C Corporation, it won't change the fact that it's a rental activity, and it still has to be reflected as such. And if we're dealing with specifically the S Corp or LLC structure, it'll just pass right through to the owners, and it'll actually play out on the ownership level. All right, so again, as I mentioned in my own words, a passive activity is something that is not active in participation. So think of it this way: if I invest in a passive activity and the activity produces losses, it cannot be offset with other active income, right? So if I have this rental real estate, and remember that it tends to create tax losses, can we offset those losses with other active income like your W-2? Generally, no, because that's what the law says. You cannot offset passive losses against active income. But guess what? There's an exception to just about every rule, and then there's always exceptions to the exceptions in our world, in the tax world. So it does get a little bit cumbersome and convoluted. But luckily, you guys have somebody like me to help clarify the fluff and bring clarity to the picture. So let's go on reading. So similarly, since the activity is passive, it would not be taxed the same way as active income. and hence you would not pay into the Social Security system with this type of income and will be subject to only income tax and net investment income tax, okay? Don't worry about that. But what I'm trying to say here is that it's actually treated differently, right? So when you earn your W-2 wages, you're being taxed on multiple levels. You got your federal income tax, state income tax, city income tax, right? If you're in a local jurisdiction earning that money. But passive income is still earned passively. I'm not really doing much, right? I'm sort of an investor. And as such, it doesn't actually trigger the Social Security Medicare taxes, or what we call FICA tax or the payroll tax. So it's treated differently. It has perks, right? We're not actually getting hit with Social Security Medicare under the rental. Obviously, again, there's many different exceptions, but in this particular case, we're just talking about rental activity. And if this was like flipping properties, that would be treated very differently for tax purposes. So rental activities you will not be contributing towards Social Security system, and hence you can already start to see why it's being kind of treated very differently from your other active earned income. All right, so since this is a passive activity, the activity is subject to passive activity loss rules. Why? Well, because of the abuse of the tax system, and we already talked about a little bit about how people tend to abuse rules as soon as they come out, and we're going to dive in more in detail as to when we hit on material participation and what that actually means. But what I want you guys to understand is that there is an exception, and the exceptions to the rules are in the following tab. So let's go into some of the exceptions. So what are some of the exceptions to these passive activity loss rules? So Greg said that if I have a rental activity and it tends to produce tax losses for tax purposes and positive cash flows, but it doesn't actually, but I can't use these losses, well, what happens to these losses and how do I get to use it against other active income? All right, so let's say there's 3 ways that you can generally use these losses when they're suspended, okay? And those would be if you have other passive income to offset it, if your modified adjusted gross income drops over a threshold, and or if you dispose of the activity in full, so a complete disposition. All right, so that's some of the ways to actually recoup the losses that can happen. But that's for the most general of terms. It doesn't always apply to everybody. So there's this thing called the mom and pop exclusion. So the mom and pop exclusion allows up to $25,000 worth of losses if you're married filing jointly, if you materially participate and have active participation. Now, those are the 2 exceptions to the rule. So you get 25 grand off, so you could have lost way more, but it'll be capped, and it starts to phase out when your modified adjusted gross income is from 100 to 150K. Once your modified adjusted gross income reaches over 150K, it's actually completely phased out. And if you think that you can do a married separately filing and still get that 25K, no. If you recall from my other videos, married filing separately is discouraged by the tax law, and they do slash things in half or disallow them completely. So this is a great example of how some losses do get completely cut in half. And so if you are doing a married filing separately, it would be 12.5 allowed. So just as if you were a single person, basically in half. So that's basically the gist of that first exclusion. So if you fall within, so let's say you're earning, I don't know, $50,000 worth of active income from your W-2, and your rental real estate produced tax losses of $10,000, and you materially participated, and you were standing and you had active participation, you're at risk with everything that deals with this endeavor, you're basically going to be allowed to take up to 25K, while others will have to basically have those losses suspended, and they will carry forward indefinitely until one of those 3 items happens, right? And one of those 3 items would be, A, you have other passive income to offset. So you go and you get a second rental activity, like in my first 3 examples, right? If you recall from the tax shelter discussion, how rental real estate works, right? So if you're here and you actually have a profitable scenario, and then you have your average scenario or even a loss, those 2 can basically offset. Right, that's one instance, and again, it doesn't have to be rental real estate. It could be just another activity that's passive. You could just be an investor. It doesn't have to be a rental real estate. Remember, rental real estate is just deemed automatically passive, and you cannot change that because the law specifically puts it into that category, so that way people don't abuse the rules. All right, so that's the one instance. The second instance is if your income drops. So once you start making over 150,000 in Maggie, it's going to get suspended. Again, the losses carry forward indefinitely, and you have to then wait till your income drops, which can happen at some point in time in the future. And this tends to happen to people that are pretty young and start investing very young. And I've seen it when I was growing up. You know, one of my friends and his partner had. When I was growing up, I know, right? Had rental real estate for many, many years. They always held rental real estate. And I grew up with them. You know, I graduated out of college and I was doing their tax returns right out of college. And I saw the transition. They started earning more money as they got older because, you know, you get older, you make more money. That's just the normal part of life. And as they would get the losses, and then about 5 or 6 years post graduation from college, they're already making over that 150,000. And one fine year, they just woke up and we're like, whoa, you can't use these losses anymore because you just made over that exception amount. And those losses got suspended, and the individual actually got a tax bill that year because they were already banking on having a refund because they were always harvesting those passive losses for years and years. And it was quite the rude awakening. So tax planning is always a good thing to do, especially if you have anything besides the W-2. Now, what's the second big exception that, you guessed it, it's definitely if you're a real estate professional. So if you're a real estate professional and you're really busy as a real estate professional, and this is your bread and butter. I'm not talking about you go out and just get a real estate agent's license real quick and you still have a job where you're very busy and have other hobbies and whatnot. That, you know, that's going to be looked at as kind of, I would hate to use the word fraudulent, but appearances versus fact. You know, this is an old accounting concept that in appearance, we can structure things many different ways, but in fact, I'm really not a real estate professional. So I can go get all the bells and whistles and kind of come off like as if I'm a real estate professional. But if you sit down and really start peeling away the layers of the onion, you're going to notice that at the end of the day, I'm just not a real estate professional because I'm not putting in the hours, and the IRS wants to see about 750 hours worth of time. And basically for that to be the most substantial amount of time that you're spending as a real estate professional. Right. So, and that can be a real estate agent and it can be a real estate broker, but it doesn't have to be. It can be, you know, just an investor. That's all they do. They have like a portfolio of tons of buildings. They're super busy with that. They really have no other job, or if they do, it's very minimal and doesn't take up the majority of their time. So, yeah, so basically those are the two exceptions, and we're going to go into the rules as to materially participation and active participation in our next segment here. But I just wanted to explain to you again how passive activity losses are defined, how they apply to the real estate rental investment game, and exactly how to harvest your losses or how not to harvest your losses if you fall into a certain income category. And how to bypass that. Now, just remember that just by checking off a box on your tax return, you can actually say that you're a real estate professional. But the IRS does run a lot of different varied tests and analyses on the tax returns when they get fed into the system, and they run variances of all sorts, and they run ratio analysis of all sorts and compare it to other people that have similar situations in their database, and they will pretty much pull it right over into an audit. And basically, when they do audit that, they go for 3 years worth of issues. As a matter of fact, a long time ago, I was representing a client that came to me with this specific case where I don't know whose fault it was, but they were marking the surgeon as a real estate professional, and that just didn't fly. It basically got caught right away because the losses were substantial, and he was basically making, you know, getting away with a lot of tax losses that clearly were not entitled to. And it wouldn't matter if that individual went and got a real estate license. They were just very busy with their own practice. And that's basically the case here. You know, you also want to take everything into consideration when you're working with your tax professional and look at the tax return to see what the output is. And I always tell people that you have to know what's going on in your tax return. You're signing the tax return under penalties of perjury. It's so important to look at all the numbers that are on your return, question them, especially if you see a minus or anything that just looks a little bit odd. It's crucial. And I'm not saying this because I think that everybody should understand tax law, but I do think that it's very important to understand what you're signing under penalties of perjury. And that is the reason you have an accountant, a CPA, or an enrolled agent that can help actually minimize the fluff and really give you that bird's eye view and the insight that you're paying for, and to help really point things out and be able to shield you from harm that can come from you unknowingly signing something that can put you into a bad situation in front of the tax authority. All right. And again, ignorance is never a reasonable cause. If you're ever pulled into an audit, they don't care. They'll just say basically that you should have hired people. There's an old case of somebody that didn't speak English and only spoke some foreign language. And that was one of they tried to plead ignorance. Ignorance is never an excuse in the tax court. And they basically said, well, I didn't speak English. Well, the tax court turned around and said, well, you should have hired somebody to translate for you and to figure everything out, because at the end of the day, you're still signing it, and that's your responsibility. So pleading ignorance doesn't help. Guys, again, thank you so much for your time and attention. I hope that this video made sense. If not, please leave a comment below. Let us know if you're enjoying our content, if you're getting your money's worth, so to speak, out of some free content here brought to you by Freeman CPA and Atlanta Business Accountants, where remember, your success is our success all day, every day. Like and subscribe, guys. We love hearing your feedback. We'll talk again soon. Have a great one. Bye.